Good morning. This is Horizons Middle East and Africa. Our top stories this morning. President Trump to announce a new Bureau of Labor Statistics boss and Fed governor in the coming days. That's after firing the data chief following weak jobs growth, and Adriana Kugler announcing her resignation. Asian stocks head towards their longest losing streak in 2 years as the weak U.S. jobs data sparks concerns over economic momentum. And glut concerns. OPEC Plus agrees to boost output further, just as signs emerge that Trump's trade war may be weighing on global growth and energy demand. It's just gone 8 a.m. across the Emirates. I'm Jumana Versace in Dubai. Well, we got a triple whammy on Friday. You first had that shocker NFP print and the fact that the downward revisions were the biggest revisions we've seen since the 1960s. The last 3 months, payrolls now averaging 35,000 versus the 100,000 that people thought it was. So that was the first shock. Second shock, Trump then went on to fire the BLS commissioner. Third shock, Adriana Kugler announced that she's stepping down. One of the Fed governors is stepping down. So she will have to be replaced at some point. And Trump said that that's going to happen this week. So all of that happened on Friday. What you did get was a massive pullback for Wall Street. Interesting day, actually, for the S&P, because on the same day, not only did it hit a record high in the morning, but it also managed to end the week close lower than where it started the week. So actually negative for the full week, the S&P down about 2%. But you can see this morning, despite those triple shocks, as I just highlighted, futures are actually doing okay today. So we're leaning towards the green, up 0.4%, perhaps because the earnings season still has been pretty strong. We can talk about that. But bottom line is, despite those shocks, we are seeing some stabilization for U.S. assets. 10-year yields, however, massive move downwards on Friday, 14 basis points lower on the day. That's the biggest single-day decline in a couple of years. The market was quick to price in more rate cuts, another 25 basis points worth of rate cuts priced in for this year. September is now 90% priced in for a rate cut as well. So market was quick to reload some of those steepening trades. The USD, you can see today, also sliding a little bit down 0.1% on back of everything else that has happened, not just the labor market data, but of course the tariff environment too, the impact that that could have on global growth. And then Brent also very much in focus today. Marginal lower reaction, down 0.2% as we speak to OPEC Plus once again bringing back extra barrels to the market. And with this last clip, that 500, around 48,000 barrels that they've announced they're going to be bringing back come September, they now have completed the full 2.2 million barrels per day voluntary cut that was introduced back in 2023. So 2.2 million barrels per day brought back to the market over the course of 6 months, and Brent still trading at around $70. Now, let's go back to that main story from Friday. President Trump is looking for a new head of the U.S. Bureau of Labor Statistics after he fired Erica McIntyre following Friday's weak jobs report. He called the data rigged, claiming political bias.
I think her numbers were wrong, just like I thought her numbers were wrong before the election. Days before the election, she came out with these beautiful numbers for Kamala, I guess Biden/Kamala. And she came out with these beautiful numbers trying to get somebody else elected. Then right after the election, I think on the 15th, November 15th, she had an $800,000 or $900,000 massive reduction. Said she made a mistake. That woman's numbers are...
Meanwhile, in an interview with Meet the Press on Sunday, White House National Economic Advisor Kevin Hassett called for a fresh set of eyes at the Bureau of Labor Statistics.
No, absolutely not. The president wants his own people there so that when we see the numbers, they're more transparent and more reliable. And if there are big changes and big revisions, we expect more big revisions for the jobs data in September, for example, then we want to know why. We want people to explain it to us. The bottom line is that there were people involved in creating these numbers. And what we need is a fresh set of eyes over at the BLS. And there are great career staffers. One of the top BLS staffers is actually working in the White House to help us understand the jobs numbers. When I saw the jobs revisions, I literally called up that person and said, I think there's a typo. Because I've been following these numbers all the way back when I worked with Alan Greenspan for something like 40 years, and I've never seen revisions like this.
The president also says he may name a new Fed governor in the next few days to replace Adriana Kugler, who is stepping down. So all of that happened on Friday. Let's pick up on the market price action and also talk about how some of these Asian markets are faring. Avril Hong is in a Singapore studio. And Avril, it's not just the weakness in the U.S. data and perhaps some questions about institutional governance there, but also the tariff impact in your part of the world as well. So walk us through the price action today.
Initially, those bets climbing on how the Federal Reserve could move to cut rates next month. And I think all into your point about the U.S. jobs data, that really initially played out in Asia stocks, which we saw the region's benchmark starting the day, I think about 0.5% lower. But it's mostly mixed now, and the region's benchmark is actually flat. So that tells us a couple of things, that maybe the Friday action, that selling was a bit overdone. Our MLife strategist offered another view that maybe Asia investors did a better job of pricing in the impact from tariffs already. So you're seeing that bounce in the Hang Seng as well from earlier declines in the session. The South Korean gauge is actually outperforming today. This is a bit of a different narrative because of how there are reports that a planned tax increase might be withdrawn. And aside from them just highlighting what we're seeing in Japanese equities, because that's where we're seeing the real underperformance today. The drag is some of it earnings related, but the banks as well. If we get a murkier U.S. economic outlook, that could also dampen near-term expectations of the BOJ hiking rate. So that is why you're seeing the banks, the drag in Japan, the yen, along with a lot of these other currencies now is actually reversing some of the earlier gains. But most Asia currencies and bonds are actually firmer in today's session, Jumana.
Yep, the yen and the possibility of Bank of Japan hiking, something I'm going to bring up with our next guest, Avril Hong in Singapore. Thank you so much. Now, traders are boosting bets that the Fed will cut interest rates twice by the year end following weak U.S. payrolls. Joining us now is Parisha Saimbi, FXLM Strategist for EM Asia at BNP Paribas. So much to talk about today, Parisha. I actually want to start with one of what I would say one of the biggest news that came out on Friday, which is the fact that President Trump has moved to fire the head of the BLS on back of those huge data revisions downwards. I have a question for you about how seriously investors should be taking this and whether there's a question about institutional governance right now in the U.S. and in the sense that the president or anyone's job may be at risk if they produce numbers that the president doesn't like.
I think it's absolutely something that markets will take account of. And I think ultimately it continues to support then a structural weaker dollar. And that is our view. And it's not really predicated necessarily on Trump and who he does or doesn't like and whether they are producing the numbers that he wants to see. But it's ultimately that we do think that there is going to be a weakening US economy. And I think the data that we saw shows some risks then that we could see some weakness further, more weakness than we expected in the labour market. But nevertheless, clearly there are some questions around institutional independence, and I think certainly that adds to the concerns then that investors have over holding US assets and what this really means then for the US economy.
So the markets were very quick to price in another 25 basis point rate cut by the end of this year. Do you think that we are now going to see a Fed turn a lot more dovish than the tone that the Fed Chair Jerome Powell took last week when he actually referred to somewhat of a resilient labor market? Of course, now the narrative has changed after that payrolls print.
So I don't think that they will necessarily change their tune just yet. Ultimately, Powell set out a framework last week, and that did suggest that if there was labour market weakness, then certainly that could increase the risk then that they do deliver rate cuts. But for us, we think that the data will stabilise at the August print, and together with accelerating inflation data, we do think that this will continue to support the Fed keeping policy rates on hold through the course of this year. So our base case is actually that we see the first Fed cut in Q1 2026, but certainly if we continue to see prints like we did last Friday, then that certainly would bring forward the risk that we could see rate cuts from the Fed this year.
Okay, so just to recap, your house view is that we're not going to get a cut out of the Feds this side of the year, that they're going to go for it in Q1 2026. So then how can you be bearish the USD?
So our view is not necessarily predicated on the path for US rate cuts. Certainly medium term that can support it. But in the near term, it's really more of a view of investors reducing their dollar risk. And I think when we look at global investors who hold US assets, it's Europeans, it's the Japanese, it's others within Asia as well. They're still holding a significant amount of FX risk on those US asset holdings. And coming back to the points mentioned before, with the risk that the US economy does turn and the risk that the Fed could deliver early rate cuts, with institutional concerns over their independence, we think that this will continue to accelerate investors increasing FX hedge ratios on their US asset holdings. And we think that that will be particularly acute against the euro. And so that's why we're most bullish on euro dollar out of all of the dollar pairs.
Okay, so let me actually pick you up on that. Last week, we saw a major downward move in the euro after that US-European trade deal was announced. Many European member states, especially France, saying that it was not a good deal for the European continent. What makes you think that the euro will see some support from this point onwards? Because the view out there is that the deal that was agreed to with the US is actually going to be very detrimental to growth in the coming quarters.
There certainly has been a lot of negative sentiment from the public on this deal. But I think ultimately this is a good deal in the sense, at least compared to peers. Europe has managed to secure a 15% tariff rate, and that is not including, or that is inclusive, of the most favored nation tariff in comparison to others elsewhere where their tariff rates are on top of that most favored nation rate. Second of all, I think some of the questions around the investments that Europe have committed to are perhaps more symbolic rather than anything more substantial. You know, ultimately, it will be very difficult to enforce some of those investments or to force companies and mandate them to invest in the US. We've seen precedent from China back in the 2018 deal that there isn't really scope for significant punitive actions if they fail to comply with the investments that they have proposed. There's no clarity on the timeline over which these investments need to be made. And so ultimately, with a deal being struck, with it being lower than some of what we're seeing elsewhere, with the certainty that this will bring back, we think that markets will refocus then on the defence package that was announced from Europe earlier this year, alongside the trade certainty that will now be brought back to the European market. And that will ultimately provide support then for the euro, alongside those hedging flows that I mentioned earlier.
Yeah. So let me just ask you also in the context of hedging flows, Japanese investors, would you look to get short dollar yen here, especially in anticipation of a potential hike out of the Bank of Japan later this year versus potential cuts out of the Fed, even if your house view is correct at the beginning of 2026?
So we do see a path for dollar yen to decline, but we're not as keen on selling dollar yen compared to buying euro dollar. And that's really because we do think that from that hedging perspective, Japanese investors, we haven't seen that flow emerge yet for them to increase significantly their FX hedge ratios on their holdings or to divest from US assets, where we have already seen that flow starting to emerge out of the European Union. So in absence of that flow, and also considering that many of the Japanese investors have sticky foreign investment mandates, we're less of the view that dollar yen can decline as aggressively compared to the rise that we could see in euro dollar.
Yeah, very clear. Parisha Saimbi, thank you so much for coming on the show today. Great day to have you on. FXLM Strategist for EM Asia at BNP Paribas. And coming up, as senior Trump administration officials visit war-ravaged Gaza, we're live in Jerusalem next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. Senior U.S. officials visited war-ravaged Gaza on Friday on a mission the White House said was about inspecting food distribution sites and developing a plan to ensure more aid gets in. U.S. Special Envoy Steve Witkoff also attended an impromptu protest in Tel Aviv after Hamas released a video of a 24-year-old Israeli hostage. For more, let's go to Jerusalem now and speak to Bloomberg's Dan Williams. Dan, on Friday, we gave a preview of Steve Witkoff's trip to Gaza and the fact that he was going to go visit the GHF, the Gaza Humanitarian Foundation. What was the outcome of this visit?
That was a 5-hour trip attended also by a very influential American ambassador to Israel, Mike Huckabee, both of them there. And it's rather clear from the statements made that they went away reassured that this system endorsed by the United States, endorsed by Israel as an alternative to the formerly UN-dominated, and they argue Hamas-dominated distribution system for Gaza, the GHF works as far as they see. So what we have here is apparently an American attempt to dispel, to their own satisfaction, accounts that have surged over the last 2-3 weeks of starvation in Gaza due to a failure of humanitarian distribution. Now, the question is if that's going to come hand in hand with endorsement for what Israel has hinted it might do, which is carry out a final military push against Hamas in the absence of an agreed ceasefire deal. The ceasefire talks have really been in limbo for several weeks now, and such an attack would presumably lead to the crushing of Hamas eventually, or at least full conquest of the Gaza Strip. It would also sadly endanger those 20 remaining living hostages in Gaza.
Bloomberg's Dan Williams in Jerusalem. Thank you very much for bringing us the latest. Now, August 4th marks 5 years since one of the world's biggest non-nuclear explosions. Hundreds of tons of improperly stored ammonium nitrate ignited at the Beirut port. The explosion killed more than 200 people, injured and displaced thousands, and devastated entire neighborhoods of the Lebanese capital. Investigation into the causes of the blast has so far ground to a halt. And coming up, Senegal's plans to raise $10 billion by 2028 to escape a debt crisis. Details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Senegal plans on raising taxes and renegotiating energy contracts to raise almost $10 billion over the next 3 years to deal with its debt crisis. Our chief Africa correspondent, Jennifer Zabazaja, joins us now. Jen, tell us more about what was outlined in the plan from Senegal.
Right, Jumana, this is an economic plan that we had actually been anticipating for quite some time from this government, especially since they had this audit that had uncovered a lot of unreported debt for the economy. Listen, so what we did get from the Prime Minister, Sonko, is that, as you were mentioning there is going to be increased taxation, which is not necessarily great for Senegal people, the Senegalese, but potentially then it gets the country back to a path of stability. So some of the ways in which they're hoping to restore investor confidence is what we heard, is they're planning to cut some subsidies, including fuel subsidies, increasing taxes on things like land, also digital and economic goods, and also mining sectors. So what they're trying to do is find ways in which they haven't necessarily been able to yield taxing and revenue in the past, and at least try to get them back on a path to stability. And what we heard from Sonko, the Prime Minister, is that he says that this new plan actually reflects their strong commitment on reinforcing their country's sovereignty, which is something that investors have been waiting for since this new administration took over. And as you were just mentioning there, their expectation, based on some of their own research, is that they can actually uncover $10 billion over the next 3 years. The question is, will they be actually able to commit to this? And at what point will investors actually feel more confident than investing back into the economy?
And Jen, what does this do in terms of putting Senegal back on a path to financial stability?
The big question that many people are wondering is how does Senegal get back there? Because it is one of these countries on the continent that had been very promising for quite some time. But as we know, and we've reported here on the show, when this new administration took over, President Faye and also Prime Minister Sonko, they did an audit. And as I was just mentioning there, they uncovered what they say were billions in dollars in unreported debt from the previous administration. So they say themselves that they inherited what was really a grossly and negative financial fiscal situation for the country. And so potentially then we actually see them being able to get themselves back on a path to where they want to be. When we actually did see this economic plan uncovered over the past few days, we did see Senegal's bonds actually strengthen, with seeming like investors are wanting to get back invested into the economy. And also, what's also very positive is that, you know, once we did get this reporting on the audit that had happened in the economy, the IMF had to shut down the fund, a facility that they had actually been planning for the country. Now our understanding is that the IMF is in talks with the economy, with President Faye, and with the Prime Minister. So potentially we will see investors again feeling like they are comfortable to get back invested into this economy, and potentially then it gets back on a path of promise, which is where it was prior to the past few years.
Jen, thank you so much. That was Jennifer Zavazaj, our chief Africa correspondent in Johannesburg. All right, let's take a look at how some of these markets are faring. It was a really big day for markets on Friday, with that NFP print surprising to the downside. But even worse than that, the downward revisions of the last 3 months, the biggest downward revisions since the 1960s. On the back of that, President Trump moved to then fire the head of the BLS. And then later in the day, we also found out that one of the Fed's governors is stepping down from her seat, Adriana Kugler. So all of that happened on Friday. So we saw massive pullback for Wall Street. S&P ending the session down 1.6%, NASDAQ down 2.2%. But things are stabilizing today. Take a look at these U.S. equity futures. Markets are leaning towards the positive. Switching over, though, let's take a look at U.S. Treasuries. Also just want to point out that the markets were quick to price in another 25 basis points worth of rate cuts this year. 10-year also moving about 14 basis points lower on the session as well. So strong rally in U.S. fixed income. But coming up, we're going to be talking about oil prices, which have fallen slightly after OPEC Plus agreed to another major output increase. We'll speak to Carole Nakhle, the chief executive of Crystol Energy, next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa, our top stories this morning. President Trump to announce a new BLS boss and Fed governor in the coming days. That's after firing the data chief following weak jobs growth, and Adriana Kugler announcing her resignation. Asian stocks head towards their longest losing streak in 2 years as the weak U.S. jobs data sparks concerns over economic momentum. And glut concerns. OPEC Plus agrees to boost output further, just as signs emerge that Trump's trade war may be weighing on global growth and energy demand. It's just gone 8:30 a.m. across the Emirates. I'm Shimona Versace in Dubai, getting your first look at global markets after Friday. All of the events on Friday, the weak jobs growth, the downward revisions, the firing of the BLS chief, the stepping down of Adriana Kugler, all of that happened Friday. But take a look at S&P futures. We're actually leaning towards the green today, up 0.3%. So some stabilization coming through, even though we saw quite a substantial pullback for U.S. equities by the close on Friday, with the S&P closing down more than 1.5% lower, NASDAQ down more than 2% lower for the week, also tracking negative as well. At 10-year yields, though, we saw a massive move on Friday, down 14 basis points. The front end of the curve also pricing in an additional 25 basis points worth of rate cuts this year. September is now 90% priced in for a rate cut as well. So the markets were quick to price in a quicker and more aggressive rate cutting cycle out of the Fed after those jobs numbers. The USD also slipping a little bit today, down about 0.1%, with everything that we spoke about, with the weakening of the U.S. economy, tariffs, Also, maybe some questions about institutional governance in the U.S. beginning to perk up as well. And then take a look at Brent as well. Brent just shy of $70 here, 69.40, only down about 0.3%. This despite the fact OPEC Plus have announced that they're putting back the last clip, that 550,000 odd, just below that barrels per day as of September. That was sort of priced into the market. But again, questions are rising about whether the market can sustain it, especially as we head into the fourth quarter. Some concerns about the global demand outlook. So we'll talk more about that shortly. Okay, let's also check in on how markets in Asia are faring. Avril Hong is in our Singapore studio. Avril.
Yeah, Jumana, after that weak handover that we got from Wall Street from Friday, after the U.S. jobs shocker, and then the early exit of the Fed Governor Adriana Kugler, overall, that coalescing of bets about a cut from the Fed next month, and then those concerns about the crack showing in the U.S. jobs market. The handover, as I said, was weak into Asia, but what's really interesting is how we started the day on the region's benchmark about 0.5% lower, and at the moment, it's sitting pretty flat. And if those declines had held, it would have been the longest losing streak in about 2 years. But now that we're pairing these losses on Asia stocks, it tells you a couple of things, that maybe the Friday action, that selling was a bit overdone, or that in Asia, investors had done a bit of a better job pricing in the tariff impact. We're seeing the Hang Seng about 0.5% higher. We have Chinese chip stocks also doing fairly well today. This is in relation to a report on NVIDIA, some export delays. Aside from that, just highlighting what we're seeing in South Korea as well, that outperformance is pretty clear. But this was a market that was on the back foot last week, if you recall. And today's performance is following on from reports that there could be this planned tax hike. That plan could be withdrawn. Aside from that, taking a look at the Japanese benchmark as well, the banks are not doing so well today. If there is a murkier outlook for the U.S. economy, that's also potentially going to dampen some of these near-term expectations of a BOJ rate hike. And as you know, the hikes would have been good for banks in Japan and their profitability. So a bit of that underperformance from Japanese lenders at a time when the yen is reversing some of the gains from earlier on in the session, but most Asia FX, along with bonds, are sitting firmer today. Jumana.
Avril, thank you so much for the overview. Avril Hong in Singapore. Well, oil prices falling after OPEC Plus agreed to another major output increase, stoking concerns about global oversupply. The September output hike announced at the weekend would complete the reversal of a cutback made by the group in 2023. Joining us is Carole Nakhle, Chief Executive of Crystol Energy. Carole, really good to have you with us on the show. You know, if you had told the market, perhaps back in March, that OPEC were going to bring back 2.2 million barrels a day of production by September, and that prices would still be at $70, I don't think many people would have believed it. What do you think experts got wrong at the beginning of this year when these forecasts of oil at low 60s or sub 60 came out?
I don't think it's that they got it wrong, but it was something that we were not accustomed to unless there was some kind of price war or market share war, whereby OPEC or OPEC Plus would put more barrels in the market when prices are trading at the levels that we have seen so far this year. So if you look at it from that perspective, you might think, oh yeah, why are they doing it? But when we take a step back and look at the overall trends and put the actions in the broader picture of global oil market, global economy, you would understand why they are doing this. First of all, we should remember that those cuts, that when they were introduced, when they were announced, they were supposed to be there for a few months only, but they have lasted much longer than that. And I wonder how much longer those OPEC members were going to sit on those cuts, especially when other members were not respecting their quota allocated and they have been overproducing. But even in terms of market trend, we see the timing has been perfect because, yes, they start to release those barrels. The price did not crash. The market was able to absorb those additional barrels. So they continued with unwinding those barrels. And today in September, also a perfect timing because you're talking about a stronger demand because of the seasonal travel period, especially in the Western Hemisphere. Yeah. But also in the Middle East region, you do have an increase in power generation, which is fueled by oil primarily, and that boosts also demand. So when you look at these trends, you would understand their actions today.
Yeah, a perfect timing to recap what you were saying. Do you think that they will now have the window to perhaps start talking about putting that next tranche of 1.66 million barrels per day, also voluntary cuts, back to the market, or are they going to wait and see?
That is already on the table, and they are discussing, or they started talking about when is the best timing for it. The market is expecting a surplus towards the end of the year, but there are two things I would take in consideration that can affect OPEC Plus decision, in addition to all the other factors that they have considered, like the cheating members, among others. And I have to highlight that it's not going to be exact barrels put in the market because some members have been already overproducing. But there is a demand outlook, and yes, the tariffs are weighing down on global economy, but we have seen some trade deals announced recently, and maybe there will be more in the coming months, and that by itself could provide a boost to global economy. But you also see some analysts predicting a slowdown in non-OPEC plus growth, but that is coming mainly next year or more in 2027. For me, the biggest factor would be geopolitics, and this is what we are not discussing enough today. What would happen if secondary sanctions from the US are applied on Russia, and on top of that, a more stringent enforcement of sanctions on Iran? You would have then a compounded effect that would justify more barrels coming to the market to maintain prices at the levels where they are and keep everybody happy, including the Trump administration in the US.
Yeah, and on that point, just to remind viewers, August 8th is now the new deadline that President Trump has given Russian President Putin to come to the table on ceasefire discussions with Ukraine. So another deadline that we have to look forward to this week. How much geopolitical premium do you think is already priced in to where the energy complex is trading right now? We're trading around $70. Is there a little bit of geopolitical premium to account for the fact that these secondary sanctions may actually be enacted further down the track and in the next few weeks?
Absolutely. That is a fear that I'm particularly paying attention to today, because having these important producers, particularly Russia and Iran, facing tougher sanctions that could curtail their exports and the barrels that they are putting in the market, not eliminating, of course, that would lead to some serious problems. And anyway, global markets are quite porous, so we cannot really stop them entirely. But there is some concerns there of having this compounded effect of losing some of those prices. I'm already seeing with some refineries in India, for example, they kind of paused or delays receiving deliveries from Russia, and therefore they are looking for alternatives because they are concerned about the threats from President Trump. That said, the threat that we are seeing in the market today, or that may become bigger, has to be taken into consideration in respect to the spare capacity that we have in the system. And at the moment, there is sufficient spare capacity to kind of dampen the geopolitical risk premium. If we take a longer perspective, the more barrels OPEC releases to the market, the thinner that spare capacity is going to run. And this is when we would be more concerned about the geopolitical risk premium.
Yeah. How do you see the inventory situation, Carole? I remember when I was at the OPEC seminar about a month ago, I had lots of conversations with analysts, and they cited actually a low level of global inventories, at least at an OECD level. How do you see that panning out in the coming months, in the coming quarters?
I would expect OECD inventories, because this is where we have more reliable data, to be shrinking or declining over the summer season. But again, global inventories, we have to be aware of the fact that we don't have accurate figure of what happens in the non-OECD countries, primarily in Asia, in countries such as China, because Asia is the growth engine for oil demand in the world. And this is where I would always treat inventory levels with caution, especially global level, but I'm not too worried about a decline in inventories in the OECD. However, with OPEC strategy, it's another dimension that we have to acknowledge that they got right. They managed to reduce the buildup of global inventories with their strategy of cutting production and keeping prices where they are. So that's another dimension that they took in consideration when they took their action to release more barrels in the market.
Carole, always a pleasure to talk to you. Thank you so much for coming on our show. Carole Nakhle, Chief Executive of Crystol Energy. Now, Indian Prime Minister Narendra Modi strikes a defiant tone in the face of President Trump's 25% tariff rate. He's urging citizens to buy locally made goods while New Delhi continues to buy Russian oil. For more, we're joined by Bloomberg's East Asia government editor, John Herskovits. So, John, talk us through how India got caught between Russia and the U.S. and the fact that President Trump is somehow using these tariffs to further some of his political goals.
Sure. And for President Trump, when he imposed the tariffs on India, he saw these as penalties for India's purchases of Russian oil and of Russian weapons. India now is the largest buyer of Russian seaborne crude in the world. It's an integral part of its economy, and it's India sees the prices as something which are good for the country. But Modi has taken this to heart. He's shown a bit of defiance, and we had some reporting from Bloomberg today that Modi has not given any instructions to stop the purchases of Russian oil. So this will still be coming in. For weapons, Russia has become less and less important for India. It used to be about 70% of the weapons that India bought more than a decade ago. Now it's about 30%, 35% or so. So Modi is facing pressure from Trump. And this is kind of a change for the U.S. For years, under various administrations, India had been courted by the U.S. as a counter to China's presence, dominance in the region. So we've seen Trump talk very aggressively towards India, making some derogatory comments about its economy, and India has responded with this support for its local products, Modi buy locally, and keeping the Russian oil flowing.
Yeah, I mean, are there any indications at all that India will perhaps curb its purchases of Russian oil if it means a more beneficial tariff rate, or is that off the table?
For India, I think that they're looking at all contingencies right now. For the farm products, something that the U.S. was trying to push, India had pushed back against accepting U.S. GMO farm products. And farmers are an important political group for Modi's party. There are local elections coming up in a few months. So we may see this as a stumbling block, a red line for India. But for Russian oil, this could be something that's on the table or at least being considered. For now, it seems like the Russian oil is going to continue going into India.
Bloomberg's John Herskovits, thank you so much for the latest. Now, coming up, President Trump orders the U.S. to move 2 nuclear submarines in response to provocative statements from Russia. We'll find out more next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. President Trump says Special Envoy Steve Witkoff will head to Russia this week ahead of a new deadline for Moscow to halt its war with Ukraine. Trump set a 10-day deadline, which falls on August the 8th, after which he expects to impose new sanctions on Russia. It comes as Trump moved 2 nuclear submarines in response to highly provocative statements from the former Russian President Dmitry Medvedev. So this is quite an interesting story, geopolitical development over the weekend. Let's talk to Bloomberg senior editor Ramzi Al-Rikabi. Ramzi, good to have you with us on the show. Walk us through what exactly Medvedev had to say that prompted this reaction from Trump. And it all played out on social media.
That's right. Keep in mind, Medvedev, as my Russia colleagues that I spoke to earlier today, it said isn't a particularly influential person in Moscow. He's a former president. He's on a Security Council, but he doesn't necessarily influence events. But he is, as he's been described, as one of one of Putin's trolls almost on social media and mocks the U.S., mocked Biden, mocks Trump and his efforts to get this war to end. So he made some comments on social media, one of them being that, these new ultimatums from Trump are a step closer to war with the United States. And there's for some reason, Trump wanted to jump on this and made a pretty alarming comment saying that he had moved to nuclear subs into position. Now, what's interesting about it is that generally a president or no one in the national security world would mention where U.S. subs are at any given time. And folks who do watch this would say that there's probably some already positioned to respond to Russia beforehand. So it's a bit of a mystery well, I would put it this way, it's a bit silly in the sense that Medvedev isn't that influential, and whatever Trump said is odd for him to say it, but doesn't necessarily change the U.S. nuclear posture. What the background here is that Trump can't get this war to end. He's been trying to push Putin towards a ceasefire,
yeah.
And at the moment, Putin doesn't seem to be interested in getting that done.
Well, that's the thing, right? Because we're heading up to another deadline later this week that's supposed to be on Friday, August the 8th. Does the Russian president pay any attention to these deadlines? Or is it something that, there's an expectation that even with this one, like with all of the other deadlines, that it could also be pushed back?
That's a great question when it comes to Trump and his deadlines. And it's interesting you mentioned expectations. Putin had said recently that the only disappointment from all of the talks they've had towards this war is what I think he called the excessive expectations to end it. He's repeated and holds by what have been considered maximalist demands, which means taking some Ukrainian territory, making sure that there's basically no Ukrainian army or total neutrality from Ukraine, and these are conditions that Ukraine won't accept. So for Putin, he doesn't seem to be fussed at all. I mean, when Trump said he was going to put more sanctions on Moscow, even Trump said it's not as if Putin bothers with these things. So we're at this point now, and we've seen with the last two guests about where OPEC is going with oil, where oil prices will be, which is a hugely important thing for Putin and the government revenues, and how Trump is wielding these so-called secondary tariffs on a country like India that buys the Russian oil. So it's almost like a bit of a game of chicken, and I think Trump is trying to balance his relationship with Modi and what pressure he can put on Putin, and trying to get himself a win, which he really loves. He wants to come out and say that he's a peacemaker and he's solved this, but Putin is making that almost impossible for him right now.
Yeah, that's a very good way to describe what's going on there. Ramzi El-Rikabi, really good to have you on. Thank you so much. Now, coming up, Warren Buffett's Berkshire Hathaway takes a $3.8 billion impairment on its Kraft-Heinz stake. Details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Saudi Arabia's biggest chemical company, SABIC, has posted a third consecutive quarterly loss. The company's results were affected by impairment charges related to the closure of a facility in the UK. SABIC earlier this year announced restructuring plans to cut costs as softer demand has hit earnings and shrunk margins of major chemical companies around the world. Warren Buffett's Berkshire Hathaway has taken a $3.8 billion impairment on its Kraft-Heinz stake. It's the latest hit to a bet that's weighed on the billionaire investor's company in recent years. The write-down, disclosed over the weekend, was driven in part by the sustained decline in fair value. But the company also said it considered its relinquishing of board seats and Kraft-Heinz's push to evaluate strategic transactions when determining how much of a charge to take. More than 3,000 Boeing defense workers are set to go on strike for the first time since 1996 after rejecting a contract offering 20% wage hikes. Boeing says it's ready for the work stoppage, but labor unrest adds pressure to its defense unit, which accounts for 30% of revenue. The company says it will withdraw its current offer to workers if it's not ratified by midnight Sunday in the U.S. And Texas Democratic lawmakers say they are leaving the state to block a Republican redistricting push backed by President Trump. The walkout will leave the state legislature short of the minimum number of lawmakers required to hold votes. The Democrats who leave will be fined $500 a day, and Texas Attorney General Ken Paxton is calling for their arrests. UN Secretary General Antonio Guterres plans to slash more than $700 million in spending and overhaul the United Nations as the U.S. pulls back support. Guterres' plan calls for 20% cuts in expenditures and employment, and about 3,000 jobs would be lost. President Trump has suspended funding and pulled out of several UN bodies. A broader review is expected to lead to further cuts. Well, speaking of cuts, let's talk about rate cuts, because more of those are being priced into the U.S. market here after those jobs numbers came through on Friday. Another 25 basis points worth of rate cuts were priced into the front of the U.S. curve. Massive move in U.S. yields. We had the 10-year yield move down about 14 basis points. A real pullback for Wall Street on Friday. But take a look today, a rebound, as you can see in the futures, up 0.3%, NASDAQ up 0.4%. We still speak to the strength of the earnings season that has come through. European markets also seen opening up in positive territory after a weak session on Friday. But that is it for Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Stay with me for Daybreak Europe. This is Bloomberg.